morning. This is Yahoo Finance's Morning Brief. I'm Julie Hyman. Barron's Investor Circle newsletter editor Josh Schaefer is back with me today. And it's good to have you here, Josh, on a day where we've got the futures trading higher. And, you know, the team knows well that all of the Iran headlines that we get on an almost daily basis, I tend to say, like, let's not talk about it unless something more fundamental changes. Yeah. And this feels like something more fundamental has changed. The U.S. has this memorandum of understanding with Iran. It seems like the ceasefire, at the very least, is going to be extended. Sure. And we're not sure exactly what this deal entails. Now, we have to caveat this. It still could fall apart.
Yes.
By Friday.
Yes.
But the market has really already moved past and is like, great, let's be through with this thing.
It seems to me, and this has really been true for several months now, the market just simply is trading on, do I think the next likely move is going to be better or worse in terms of, is the war going to intensify more or intensify less? And I do think, regardless of what we think about the language and all the little parts of the supposed deal that might come, the overall read is, we are closer to the end today than we were yesterday, or I at least don't think it's going to intensify more in the next 4 days. I think the interesting part to me is just looking at the market. Oil's at $80. All of a sudden, you got WTI down to $80. That's its lowest level since early March, which was really the first week of the war, second week of the war. And so this is one of the bigger moves when you zoom out over the past couple weeks and just look at oil. It really has kind of fully come not all the way back down, but I don't know if it's really going to go back down to where it was trading before the war anyway. It seems like maybe you are getting to a sustainable level around 80 now, if it can hover there, that I think people will be okay with.
Yeah, I mean, the caveat from all the oil people is, it takes a while. It's not like you just turn the spigot on, et cetera, et cetera. That said, one of the fascinating aspects of this whole period of time is the disconnect between the oil people and what the price is and the price action, right? Like consistently the whole time you have had people in the commodity industry saying the way that oil is trading does not make sense. And oil has just continued to trade that way without care for what they think about it. Yeah. And that seems to be even as we were approaching, here we are in mid-June, a time when many of these oil pundits were saying, the price has been held up because hasn't gone up more because there are these stockpiles in various areas. There's things happening. That's going to change in June. We're going to run out of those stockpiles and we're going to the supply demand equation will change a lot. Again, the price was not acting as though that was going to happen. And so now that this thing maybe is actually finally coming to a close, maybe oil will come down more. I don't know. It just seems like it's sort of confounded the logic on the ground.
Well, and I think that's why the market, there's also the AI side of this all, and how much did it really matter to AI stocks, and AI stocks rallied, and that's what brought the market back. Caveat aside, I think that's maybe why in general stocks just haven't cared that much, is because if you just keep saying this is going to matter, and it isn't mattering, at some point, I'm sorry, I'm not going to sell my stocks and be defensive for no reason. Yeah. And I think that's sort of the stance you've got. It'll be interesting to see once the market actually opens and sort of what leads over the next 2 days. Because you've had this stealth rotation a little bit out of tech into some of those more cyclical areas. That has been the call for, if oil can come off the boil, I want to be more positioned to a little bit more of a strong economy play, because I do think the general data has been telling you that. The data has been strong now for 2-3 months. You just haven't felt that confident in the overall story, because it's like, well, oil could eventually weigh on the consumer. Oil could eventually cause a giant inflation problem, which maybe we're in the middle of. But I also was reading commentary after the last CPI print, looking at gas prices, and you have national average gas coming down over the last couple weeks, saying,
I paid $3.99 this weekend.
There you go.
It's very exciting.
And so maybe that's the peak of headline CPI then too.
Yeah. And
so if that's your peak, it's not all that bad.
I mean, the oil folks are still not willing to say everything's okay. I was reading from Rystad, Claudio Galimberti this morning. He's the chief economist over there. He sent out a note and he said, just be careful here. He says, quote, a signed agreement is not a functioning one, and the sequencing dispute with both sides insisting the other must move first remains the main fault line. And he also talks about Lebanon, Israel's involvement and attacks in Lebanon are also a sticking point. Israel reportedly not happy about this. Okay, so they're kind of sticking to this be careful, we're not done yet. And they might be right.
Yeah.
But again, equities don't seem to care.
No, and I think the story has kind of been the same pretty much the whole time, which is who does higher gas prices really matter for? And is that the group of people in the US that are driving the stock market? No. So then the story just kind of stops. It starts and stops there to me, I think, and it'll be interesting to see how it plays out over the next couple of weeks. You're also getting into a period now where you're going to have the Fed meeting this week. There's going to be other things to talk about, at least for this week. I think Micron earnings are coming up at the end of the month, so you'll get a little bit of focus there. But when the war has really been able to take control of the market or been what's driving the market on a morning like this morning, it's when there's just less news. And so you need more of a newsless week, which I don't think you're really getting this week.
No, although we're kind of like, besides those Micron earnings, we're kind of coming to that lull period.
Less corporate catalyst, yes.
Yeah, exactly. I'm wondering if energy is finally going to give up its spot as the top of the S&P this year. Because even with all the volatility, it is still the best performing group.
Is it still?
Yes.
So what's next, tech?
I was just looking at how it's done over the past couple of days, but it's not, I don't think, tech is number 2, industrials are number 3. And all of those have outperformed the market this year. Materials, real estate, staples have all outperformed too.
Yeah, one I've been watching there too in terms of laggards that was starting to get a little bit of a bid. 2 interesting ones actually. I think financials is interesting. When you think about the pickup of this IPO market, you still have deregulation in some of those tailwinds, and then you have just a general, I again would argue, a stronger economy than many people maybe thought a couple months ago. To see financials as one of the biggest laggards in the S&P 500.
It is the biggest, yeah.
That has been an interesting one to me. Yeah. Real estate has suddenly been part of this rotation over the last couple of weeks, which has been rather curious.
Yeah.
Because we're not necessarily talking about rates coming lower, so I'm not sure what's fully working within that sector, why people are flooding into there, or maybe it's just like we've seen many times in the past couple of years, it's just a rotation into things that haven't worked.
Yeah.
And it's only a 3-day rotation.
Yeah, we'll see.
And then it just pauses.
Yeah. Speaking of things that haven't worked that are working this morning, maybe contingent on hoping for lower rates, is Bitcoin.
Bitcoin? Where's Bitcoin at this morning?
Bitcoin is at 66,000 or so. It's seen a bounce up off of that sort of 60,000 threshold. And I saw Eric Jackson on Twitter on X taking a victory lap this morning, saying he was talking about it rebounding from the 60 level. I mean, it's easy to say.
I think you got to get Bitcoin probably to 80,000 before people start caring.
Yeah.
Give me like an over 20% rally, and then people will start talking about the momentum of the price, and here we go, price begets price, and Bitcoin will start rolling again. But I think right now it's still not that interesting.
Well, and it's not that interesting. I mean, it's a chicken and egg thing, but like as long as tech is working, the AI trade is working, SpaceX, and then we have the other big IPOs that are coming. As long as those are exciting, and Bitcoin's not going to attract that same kind of excitement money, you know, that has chased those other things.
No, take all those stocks that seem to go up every day, and then put some prediction markets on the World Cup, and there's your speculation for through the month of July.
Exactly. So it doesn't seem like Bitcoin will attract any of that in the meantime. You mentioned the Fed, which of course is happening this week.
Yeah.
Fed chairman, as we were discussing this, he wants to be Kevin Warsh. It's going to be his first meeting. And so there's a lot of speculation about what that first meeting is going to be like. I mean, here's a guy who wants to talk less to the public, but he is still part of the machine that gives these press conferences every single time. He has now the good fortune to be speaking on a week where it seems like the price of oil is coming down, which was really going to be a big conundrum potentially for him. And so, maybe he's sitting a little prettier than he would have been otherwise.
To me, the biggest takeaway or thing I'm most excited for Wednesday, and I think a lot of people in our industry would agree, is just simply how the press conference goes.
Yeah.
Because the thing about a press conference is the person speaking really gets to dictate how long it goes and how much they want to give with answers. And there's 2 different sort of stall tactics you'll see people use with that. One is you ask me a question, I'm going to give you a meandering 5-minute answer to just take up time here and say, okay, I didn't really say anything, but I'm the one talking, no one's going to interrupt me. Or you could do, which one of my colleagues suggested, which I thought would be funny, the Bill Belichick route, the former head coach of my New England Patriots, who used to go up and famously give 3 to 5 word answers. You'd ask him a question. He had a famous press conference where he just said, we're on to Cincinnati. He was frustrated, and he gave that answer to basically every question and just chose to essentially not talk. And I think that is also a route that you could see Warsh take. And I think if you're the market and he doesn't say much, I don't know how that gets received.
Yeah.
Probably just, okay, then we're going to put more weight on the SEP, which he does not seem to want as a chair.
So the other big question is he going to opt out of a dot?
Yes, he could opt out of a dot.
Is he himself going to give a forecast in the summary of economic projections? I think that'll be really fun to see if because I don't know. I think we're all a little bit over the dots.
I was going to say, are we pro or anti-dot plot?
I'm a little, like, when he, as laid out by Nick Timrose in his piece in the Wall Street Journal this morning, the argument that Warsh has made in general about communication is once you've put that out into the public, your forecast, you sort of then become emotionally attached to it and rhetorically attached to it. And so your inclination is to support it even if the facts on the ground don't. So it's harder to change. Now, I don't know if that is true in reality, but it feels true-ish, right?
It will, in some ways, it just creates more work, I think. You have to put out a forecast in the middle of June and say, we're projecting X amount of movement in the benchmark through the end of the year. And then something can change in a week or 2 weeks, like the war and what was happening with oil prices. And then you need to have Fed speakers go out and start giving speeches and talk about how they're digesting the new data, et cetera, et cetera. And maybe if you just communicate a little bit less, you don't have to then go out and say, oh, that thing that we said a week ago, we now feel differently about. So it just creates a little bit less back and forth because there is too much back and forth. It's pretty useless when you really think about it. The amount that we hear from the Fed and the amount that interest rates where they're going to be in December are debated right now is just kind of useless because it does change so much. We've seen it the last 3 years.
We don't really know where they're going to be.
Yeah, pricing is always off. We talk about that Fed watch tool. Yeah. It's useless if you look out over 6 months.
I mean, I like the press conference because I find it interesting.
Yeah.
But the dots I find less interesting. I did think it was interesting, just speaking about policy itself, Krishna Guha over at Evercore ISI wrote this morning talking about the Iran war. He says the U.S. rate outlook decoupled from oil a month back, reflecting wider uncertainty as to whether underlying inflation will decisively downshift. So I thought that was an interesting view. The idea that okay, oil's out of the way now, everything's going to be fine. And I think a lot of economists have sort of pushed back against that and said some of the services components are still a little sticky, some of the goods components are still a little sticky. I don't know if they'll be sticky enough for the Fed. I've said before, I don't think the Fed's going to hike, and this, I still don't think they are.
So the economists I've spoken to and some of the strategists, what I've been asking them about is if the Fed could cut. And what people seem to agree on is, yes, the inflation side of the story we're talking about because it's important, it's clearly the key driver, but if you flip to the labor market side and just think about what the argument was to cut entering 2026, that is no longer there.
Right.
You now have payrolls accelerating on a 3-month period. You have the unemployment rate staying flat at 4.3%, not advancing toward the cycle high of 4.5. Why would you, and inflation is sticky. So if inflation is sticky and then we start evaluating everything else, there's no reason to cut interest rates.
Right.
So you've lost your reason. And if anything, I've seen some folks start to argue there isn't a wage price spiral problem yet. What if that could also be brewing within the labor market? You start to get a tighter and tighter labor market and not the 2021, 2022, we're all going to leave and go get 15% pay increases like was the national average at one point, but just a little bit. Because right now the labor market isn't feeding that inflation problem at all.
No,
but that's another inflation concern that you could throw in there that sort of leads to how do they cut?
Yeah,
how could they cut this year?
I have a harder time seeing a wage price spiral at a time when inflation is outpacing wage growth.
Sure.
That's hard for me to see. And even with oil prices, off the table, I don't know how quickly that relationship is going to change and that wage growth is going to once again outpace inflation. It doesn't feel like that's going to be like an instant kind of switch.
Yeah.
And so if you're the Fed, you don't like that number, that relationship, but it's hard to influence one positively and the other negatively, right?
Yeah.
You can't make wages, from the Fed's perspective, it's a pretty blunt instrument when you're talking about interest rates and the effect it has on inflation.
Yeah, and I think as we're talking about oil coming down and maybe you did just see a near-term peak in inflation, at least on a headline level, something we had talked about, I think this was last week, was just the process of the Fed and how many meetings it would actually take if they operate as they normally do to get to a hike.
Yeah.
And I do think that is starting to make me feel more promising that they won't hike this year. So if you would have to flip to essentially neutral in June, maybe start getting toward a tightening bias in July. Jackson Hole's probably actually a balance sheet meeting this year. I don't know how much that's really about interest rates. You get to September before you can even start debating it if you're operating on a we move very slowly process.
Right.
And then maybe you do start to get at least inflation prints that look better. Right now, our problem is all the inflation prints look worse than the month before.
Yeah. I mean, and you could also see a scenario where Kevin Warsh, who's been a proponent of shrinking the Fed's balance sheet, where he could maybe successfully convince the rest of the Fed, we don't need a hike, maybe we just start trying to tighten a little bit at the margins, that balance sheet.
Optically, I just don't think they want to hike.
Yeah.
I just don't think that that's something that they're really that interested in.
I think that's right. And it doesn't...
They need their hand to be forced to do it.
Yeah.
And I don't think they're close to their hand.
Yeah, and I don't think it just has to do with the person in the White House, which you might assume, but I don't think that's actually the case.
No, it's flipping. Yeah, it would be flipping the entire path that they're trying to be on here.
Yeah. All right, let's talk about SpaceX, day two.
Sure.
Because the shares, I believe, last I checked, they were indicated to open higher after rising on Friday. And you and I were SpaceX'd out, maybe.
Sure.
After talking about it so much that day. But at the end of the day, the process itself was uneventful, right? Which is good.
Yeah.
Good from the Nasdaq's perspective, good from the underwriter's perspective, good from the SpaceX's perspective. Nothing dramatic went wrong. The stock went up it opened at a reasonable place. It went up a reasonable amount. It wasn't nothing about it was crazy. So seems like a win.
I think we're already at the point where I care but don't care about what the price is doing. Well, because sort of my argument has been people keep asking about it getting in the indexes, which it won't be in the S&P 500, presumably, unless the rules now change, even though they said they weren't going to change them. It won't be in the S&P for a year. It will be in the Qs, I think, by mid-July, the QQQ, the Nasdaq 100 ETF. But it won't have that big of a weighting. I just don't think a company that trades at 100 times sales is going to tell us much more about the market and the market environment other than just investor sentiment, a little bit of euphoria, the same way that when we're looking at a heat map, we look at Tesla. And it's okay, everything that is a little bit on the junkier side from a profitability standpoint and has a very high valuation is up today. SpaceX will go in that bucket. But I think that's where SpaceX just stays for me now. I think it getting the 20% pop told me that, okay, the market would be ready to accept Anthropic or OpenAI. But beyond that, beyond the market probably won't sell off those stocks on the first day, those are totally different stories than SpaceX. How SpaceX trades over the next 2 to 3 weeks, couple months, I don't think tells me how Anthropic will do as a stock. So I'm sort of all right, here we are.
Right.
SPCX, I'll look at it every now and then.
Well, and I think you wrote this weekend about it also, and you kind of pointed out that you have to look at this over the life. It's not really about the first month or year or whatever. It's about the life of the company. And you pointed out Facebook, when it went public, of course, had a very rocky opening. And then it took, Tesla for that matter. It took a while for Tesla to be Tesla from a stock perspective. And so, and SpaceX is especially a company, again, where it's it's not about what it's going to be making this year or next year. It's sort of these long-term, lofty goals that it is set for itself. So, we can kind of put it to the side for the moment.
Yeah, and I think what you keep an eye on is how those long-term lofty goals shift over time. That was part of what I wrote about with Meta was in 2012, Facebook was a company where people were debating if they were going to be able to generate ad revenue off mobile social media. That has become literally laughable. But now the company doesn't really even trade off that. Yeah. We're good with Instagram. We know Instagram works. Reels is very popular. WhatsApp is one of the most popular apps in the world too, their messaging app. That's fine. That's a great part of the story. The question is, what is the AI CapEx investment? What is going on with Llama? What is going on with the Ray-Ban glasses? These are all things that you just couldn't even have fathomed that existed 15 years ago when the company came public. And SpaceX, I think, will be a very similar story. Because if there's one thing that I would be sort of confident on if I was buying SpaceX today, is we were just debating this off air about the story.
Yeah.
Elon will chase where the ball is going,
Yeah.
if not try and drive to where the ball is going
Yeah.
with AI. So I think you're betting on him being a part of whatever the next leg of this thing is that I don't think you and I can really guess what it is.
Yeah.
And that's sort of the point, is he's going to go from making EVs to making full self-driving cars and robots and like fully start to pivot a company that you once thought was just launching rockets and doing a few other interesting things. And I don't know what the thing is in 10 years,
Yeah.
but I feel pretty good that we could be sitting at the desk talking about an entirely different thing if we were having that debate.
Yeah, I think that's
And that's why you buy it.
Yeah.
If you want to buy it, I think you have to believe in the Elon bet and
Yes.
believe in the fact that he'll be a leader of whatever is sort of next.
or if not believe, at least like want to buy an option on it.
Yeah, exactly.
You know what I mean? Even if
Just
you're
like-
not like that convinced yourself, you're like, oh, I'll throw a few bucks on the idea that could be the case.
Yeah, you just have to admit that he's the world's first trillionaire for a reason.
Yeah. Yeah.
He's an innovator, if nothing else.
Yes. And a very good marketer.
Yes.
All right. Finally, there's a lot of sports going on.
Sports are hot right now.
Sports are so hot right now.
Sports are back.
They're so hot that I, not a sports fan, am sitting here bringing up sports.
Yeah.
It's hard not to be in New York City, even not being a sports fan, and not have, or even not being a Knicks fan,
Correct.
and not have Knicks fever, because it is very exciting.
Well, I think, so one of the things that's been funny for me, so Boston sports fan, here's the caveat.
Right.
So I'm
Yes.
by no means a Knicks fan or any New York sports. I think it's been funny to see how big New York is as a city. So it feels very big to everyone here. And it is a big deal in the sport. They're one of the most popular NBA teams. They won for the first time in 50 years. But also there's like this assumption that everyone in the country is like obsessed with the New York Knicks if you walk around the city here. And when I tell people, oh, I'm a Celtics fan, like I'm canonically not really rooting for the Knicks. I think it's fun for the city.
Yeah.
They'll be like, what do you mean? You're not into this? And it's like, no, that's not how sports work. Like, you guys are all excited and that's great. I understand that.
Yeah.
But the rest of the country doesn't love New York City sports.
mean, but
People actually love to hate New York sports.
But that's classic New York City chauvinism. We're
Yeah.
the center of the universe.
Yes,
Like, that's,
they're like,
that's
look
just
how
we
good
feel
it is
about
here.
Yeah,
but I
of
do
course.
think it's been fun. You throw the World Cup in. The World Cup has been
Yes.
very exciting to watch over the first week and see the different fan bases going to different places. Yesterday I was watching Netherlands, Japan, both of those different countries sort of taking over Dallas, Texas was interesting. Funny comments online, people going to Texas Roadhouse
Yes.
for the first time.
Everybody
figuring out you
loves
can
like
get a nice
following
butter
these
cake.
tourists, these young tourists who are making their way across the United States.
Yeah, it's great.
Or on social media.
I think it'll be interesting to see at the end too what the economic impact story is, because there's been reports that it will boost economic growth
Right.
to some extent.
Yeah.
But you go back a couple years ago, I mean, it was shocking how much that Eras tour and the combination of the Barbie movie, et cetera, actually economists really writing about it mattering in Q2 and Q3 growth, and I wonder if that will be part of the World Cup story, because
yes,
it really has been crazier than I
It
thought.
will, but it is less a surprise, I think, than those things
Yes.
were, right? Like, because people have obviously World Cups have happened before.
Yes.
And so they have something to model against, and so we've all seen like the economic forecasts
Yeah.
of all of that stuff. There was also the other sporting event that happened yesterday at the
Yes.
White House.
Overshadowed, I would argue.
I think
Between as a general sports fan, that watches most major events, I had kind of totally forgotten that UFC was going to be on the White House lawn last night, because there was so much excitement about the NBA Finals. The Stanley Cup playoffs actually ended last night too.
That's right.
And then UFC just sort of thrown in there on, if it had been at a better time, I think it would have been a lot bigger deal nationally.
Yeah, maybe it was.
Missed opportunity. They'll have to do another one.
He's only going to turn 80 once. All right, Josh, thanks so much for being here. Appreciate it. Opening bid is next on Yahoo Finance.
Good morning and welcome to Opening Bid. I'm Brooke Mama in for Brian Sazi, and this morning we're watching oil prices decline after the U.S. and Iran reach a deal to end the war and reopen the Strait of Hormuz. Now, a signing ceremony for the deal is set for Friday in Switzerland. Geneva is expected to be the place of the signing, but Brent futures sinking to levels that we have not seen since before the war began. However, the International Energy Association estimating that even if the Strait of Hormuz does reopen, it'll take about 2 months for oil flows to return to those pre-war levels, so quite some time. But that hasn't stopped investors from piling into more bullish bets, with equities rising in the U.S. and internationally. Cryptocurrency also surged following news of the deal. Here to break it all down, we have Art Hogan, B. Riley Wealth Chief Market Strategist, alongside Yahoo Finance's own Jared Blickery and Inez Ferre. Good morning. Monday, M&A mania. We also have some excitement, some momentum on this Monday morning. Inez, I want to kick off with you because oil futures are on the rise. What can you tell us there? And can we see that return to pre-war levels, Inez?
Look, all of this will really depend on the Strait of Hormuz and that reopening of the Strait of Hormuz. You have some news out of Iran that the marine traffic through the Strait of Hormuz will be coordinated between Iran and Oman. So that still remains to be the big question here. You have President Trump that has said that he is authorizing the opening of the Strait of Hormuz, that he is also taking that blockade, the U.S. Navy blockade, away from there. But really the question is, how long will it take to get the flows moving again to the levels where they were before the war? And as you had mentioned, it will take weeks, if not months, to get those flows back up.
Art, it feels like we've heard this story before. Do you think that this agreement actually does get signed on Friday? And also, what could 60 days of negotiations of Tehran's nuclear program look like? And how will markets react to this? Because we're seeing optimism today. Does this optimism hold on, Art?
Brooke, that's such a great question. I guess the 49th time is the charm here, and we're going to believe that this is the real deal. And that's good. The market is telling you exactly how it would feel if we can actually get the Strait of Hormuz open and find an off-ramp to this war with Iran. So clearly that optimism is playing into markets today. And as hit it on the head, though, when she talked about how long it takes to actually operationally get the Strait open. Because first, you have to go through a process of demining, and that could be a couple of weeks. But you also have 600 tankers waiting to flow in both directions. So, and this is a strait that handled, about 100 a day back in pre-war days. So, that's a significant backlog. And then to get those offloaded and make that round trip again. So there's going to be some things that will take some time. Let's just hope that on Friday we get this signed and the 60-day negotiating period actually results in something that both sides can live with.
But Art, you think that we will eventually see the return of that 20% of the world's oil supply passing through this strait not a problem?
Yeah, it's all sorts of things, not just oil, but everything that comes out of the barrel, things like helium that are really important, and fertilizers, et cetera. So yeah, it's imperative. So we lost about 20 million barrels a day. With some rerouting got us back to about 5 of those. So we're still left, between 14 and 15 million barrels a day. If that had kept on into the month of July, we'd be in significantly more trouble here. So I think that's the immediacy of getting this up and going, such that we can get back to that deficit or reduce that deficit of 14 million barrels a day. That's really pressuring all sorts of economies.
Right, and we've seen the ripple effects that in the latest inflation print. I know we'll get more to that with the Fed later on in the show, but Jared, I want to hit on you because we are also seeing global stocks rebounding quite significantly. What can you tell us there, Jared?
Yes, let's go straight to the Wi-Fi Interactive. We saw a pop last night when U.S. futures opened. I saw the Russell 2000 hitting record highs on that open. That was Sunday night, but let me just show you what the rest of the world has been doing. Focus on Asia here because these are energy importers. Korea was up 5.2%, Tokyo up 5%, China up over 2%, and Hong Kong and India also up. Throw Australia in there too. They have to import crude oil as well. And let me just show you a crude oil chart real quickly, and then I'll show you a few other markets. This is a 6-month look at WTI crude. I'm going to put some candlesticks on there. Just want to show you, over the last 3 sessions, we have quickly fallen to 80. That is a level which has contained price before. I wouldn't be surprised to see a little bounce here, but if it looks like this news has legs, we should be stair-stepping down. I don't know if we'll get to 60, but we should be stair-stepping down through that 80 mark. And if we pop back up above 90, that is a warning that the market doesn't necessarily believe that this latest detente is on, and we're probably going back up to test that upper end of the range, north of $100 per barrel. Just want to show you real quickly what's happening in the stock market here. We got tech surging. It is another risk-on day for the market. Consumer discretionary, industrials, materials surging, even financials up more than 1%. And what's not working? That big energy trade, along with some other defensive sectors here. So definitely looking risk-on from the get-go.
I do want to stick on that energy trade because, Art, you had wrote in your note that that's somewhere that we have seen the largest momentum of year to date. And now month to date, we're not necessarily seeing that same return. Now today with this news, it seems like investors even pulling away from energy even more. So how are you thinking about this sector moving forward now with this latest development?
Yeah, so I would say the good news on energy is that while we saw a significant increase in crude pricing from $65 pre-war to north of $110 a barrel, the energy complex never really priced in that level of increases. So, while there will be some give back in the energy sector, which is the best performing sector in the S&P 500 on a year-to-date basis, I don't think it all collapses. And I say that because while the supply and demand was very imbalanced pre-war, the demand side was growing significantly, both out of India and most of Asia. So I think that there will be a pullback in energy, but I think that's going to be a buying opportunity. All of the global fully integrated energy companies are running their businesses very well, very profitably, and are very profitable in a crude market that is north of $50.
And as quickly, we're also seeing crypto return to rallying to a 2-week high. What do you make of that?
Yeah, look, crypto is bouncing along with the overall market, but you still have strategists that are warning that unless you see Bitcoin going up above 70,000 and staying there for a while, they are not so necessary. This may be a sort of what one strategist had called it a dead cat bounce within the broader crypto still winter market or bear market, so to speak. So you really have to watch to see if it goes to that 70,000 level, if it can go up there and really stay there for a bit, because they're still talking about these overhangs that are around Bitcoin. You've got the strategy overhang. You have also the quantum risk overhang. And then, of course, what the Fed is going to do, because really, if the Fed pivots to, if the Fed pivots to being more easing, then that will be good for crypto. If the Fed pivots to a more hawkish stance, then that will be negative for Bitcoin.
Jared, really quickly, airlines also seeing similar momentum this morning. Obviously, given potential lower fuel costs, it seems to be having ripple effects about what this can mean for airlines.
Yes, definitely an immediate hit or an immediate boon to the sector. Let's check out the Wi-Fi Interactive, and you're going to see a lot of these travel stocks just popping right now. And you can see everything from the airlines, which you were just mentioning. We got Delta up almost 5%, Southwest up 4%, United up 7%, to some of the bookers like Booking.com, which is in the upper left. That's up over 5%. Even the cruise lines, Royal Caribbean up 6%. If I sort by performance, you're going to see some of the small squares before. Once they get bigger, it's because we're sorting by performance. Like Frontier, some of those smaller airlines are up over 10%. So there's Frontier Group. This is year to date. You can see it's kind of come back nicely off of those March lows, up 50%, but it's up 11% today. JetBlue up 10%, and Alaska Airlines 7.5%. It just goes to show you the more fragile carriers are the ones that are benefiting the most, and that's not exactly a surprise.
Yeah, and this comes after those companies said that they were losing hundreds of millions of dollars on higher jet fuel costs. So we'll have to keep a watch out for that to see the implications and how exactly this does flow through. But big picture here, I have to get to this, guys, because it is a merger mania Monday, M&A Monday, whatever you want to call it. We had some major announcements today. Fox now expected to buy Roku. We also heard Salesforce making an acquisition of a customer agent company. We also have others also announcing deals. Art, what do you make of this M&A announcements this morning, specifically within the companies announced, but just big picture here? Does this sort of show you this risk-on environment returning?
Yeah, I think it's a couple things, Brooke, and you bring up a really good point. The market conditions are very advantageous for M&A activity, but the regulatory environment is as well. So a lot of deals that were announced over the course of the last couple of years just didn't get approval. And now in an environment where the regulatory touch seems to be a bit lighter, you're actually not just hearing announcements of deals, but they're actually getting approved. So I think that has opened up the gates where we're going to see an amplitude of capital markets activity, certainly M&A, and as we saw last week, some pretty big IPOs as well.
Right, we'll get to more of that SpaceX IPO. That's a bit of a deep tease coming up next. But Inez, it seems like we're getting a bit of a mixed reaction to that Fox Roku announcement as well. Do you think that investors maybe don't have as much of an appetite from a Fox perspective?
Well, look, for Fox, this is a beneficial acquisition because, I mean, they even talk about it in their press release, cable and the sort of trends that you're seeing in cable subscribers. So for them, this is really marrying their live sports, their news, and then directly marrying that with Roku and its platform. So you're looking at Roku shares that are down right now, and Fox even more so. But this is a strategic play for them. And I think that overall, when you talk about these mergers that have been announced on this Merger Monday, you are really talking about strategic plays when it comes to all three of these that you just mentioned.
Art, quick follow up there, because, you know, we got one announcement that's sort of in the media space after we had that major Paramount Warner Brothers announcement. And on top of that, too, we got Salesforce acquiring this customer agent, more of an AI play here. Where do you think we can expect M&A to happen? Do you see it in certain sectors? Is this sort of just opening the floodgates overall?
Yeah, I think that's a really good question, Brooke. I think the largest of the M&A activity is going to happen in the financials. We have too many banks, and it's expensive to run a bank with both technology and compliance costs. So with 5,000 publicly traded banks, you likely are going to see a lot of combinations there. I think the largest beyond financials is going to be in healthcare, and we've already heard some biotech deals. Lilly's had about 6 deals announced this year, and I think that continues. Large cap pharma, large cap biotech need to fill their pipelines, and there's a lot of small cap biotech companies that are in phase 3 trials of some really exciting drugs. So expect healthcare and financials to be the largest of the M&A activity sectors.
Interesting. It seems like healthcare, we've been buzzing about it for quite a few months now, so I'm going to keep a lookout for that one too. Art and Inez, Jared, stick with me. Don't go anywhere, because coming up, we do have our stock of the day, and hint, it's already become one of the most popular bets for retail investors, even in its second ever day of trading. It's time now for a stock of the day, and it is SpaceX. Elon Musk's space exploration and AI venture just notched the largest ever IPO, raising $75 billion in its public debut. It ends its first day of trading with a roughly 20% gain on the IPO price of $135. Now, this marks SpaceX's first week of official trading, so we'll see where the stock goes next, but it's already hitting more milestones, including record interest from retail investors. And I do want to get to Alpha Space on my computer. This is the Yahoo Finance's new trading platform. And what we're seeing here is this 6% pop this morning, as you can see right there, now sitting at 170.70. Also here, if you scroll down, you do have a better understanding of where exactly SpaceX stands within the space race. And just to give you some context on the valuation of this company, right there it is, market cap of $2.11 trillion as of this morning. And to give you context of just how large that is compared to some of the other players, when you take a look at the heat map by weight of market cap, it is really overtaking the space exploration name. So let's dive more into this. Let's take it to the opening bid panel with Art Hogan, Inez Ferre, and Jared Blicker this morning. I mean, what a debut, guys. We were covering it on all fronts on Friday. This was just excitement after excitement. As soon as it opened at roughly 11:45 a.m., the excitement just kept continuing. Art, I want to get to you because this was a historic debut. It was set to go at an IPO price of $135, debuted at $150. Now we're already up $20 on the first day. What did you make of this?
Well, a couple things. I think the fact that they were able to get this out and with very few bumps in the road. You didn't hear about any disasters, any halting of trading, all the things that could go along with the massive amount of volume that was introduced to the market says the plumbing is working well. The fact that there was an audience for this and demand was, depending on who you believe, 2 to 4 times oversubscribed is important as well, because there's a lot of large cap names that are waiting in the wings to IPO themselves. I think the fact that this went 20% retail is very telling of the fan base or the disciples of Elon Musk that are willing to believe that in 2030, the revenue picture will look much different than it does today. As a matter of fact, he's projecting, Elon Musk is, that he's going to double revenues every year for the next 5 years. So it's a belief in what Elon Musk can do, and that's why there's such a large cohort of retail investors that are also Tesla investors.
It really is that future earnings potential that had investors so wrapped up, so excited. And now over the weekend, Elon Musk trying to keep that momentum on, because he did say that, like you mentioned, Art, $1 trillion by 2030. I want to take this to Inez, because in 2025, the company only brought in about $19 billion in revenue. So make this make sense.
Yeah, look, investors are used to Elon Musk putting projections out there, and lofty projections. Keep in mind that more than a year ago, Elon Musk had talked about Tesla reaching a valuation of somewhere around 25 trillion. So keep that in mind, that these projections are what Elon Musk puts out there as far as where the company is going. And that's part of the vision. That's what the retail investors and the rest of investors that are in this stock are really buying. But if you take a look at what the street is expecting, you've got Goldman Sachs that's saying that revenue by 2030 coming in at $470 billion. That's because of AI infrastructure and data delivery. You've got Morgan Stanley that is projecting somewhere around $330 billion, and New Street $195 billion. So really different sort of projections when it comes to that 2030 timeline.
Jared, you mentioned, or you've been following this retail investor excitement that Art had mentioned. What did you make of that on Friday? And it seems like it was pretty a record-breaking retail investors buying up this stock. What can you tell us there?
Yes, well, first of all, I agree with Art 100%. There were so many things that could have gone wrong with this supersized IPO. It came off very, very smoothly. So that's a win for the Nasdaq. And just, getting that out of the way, Vandatrack, they track retail investors. They said that SpaceX is trading like a retail mega cap on day one. So that was Friday. They brought in $117 million. There you go. You can see on your screen how this compares to Coinbase back in 2021, Uber back in 2019. If you take a look at the dates down there, all these IPOs that did not attract nearly as much volume, we haven't had that many recently. In fact, in this latest bull market that began in late 2022, I'm only seeing ARM down there in the bottom row. So there was a huge response here, and this was very uncharacteristic the way the retail trade has leaned over the last few years. Now, I do have another few notes here. Vanda has been concerned that there was being room made for SpaceX by investors kind of taking their investments from other places, and specifically the chip stocks. So they saw some selling last week in some of the big year-to-date winners like Micron and Robinhood. But you put it all together, this was a huge win for, I think, the retail and IPO crowd, as well as the Mag 10, because that's what we have now. Once we get these other two IPOs coming down the pike, we're going to have 10 supersized. You can throw Broadcom in there. The list of trillion-dollar companies is only going up. And I just want to show you one more thing on the Wi-Fi Interactive. First, this is, Brooke, this is exactly what we were looking at before on AlphaSpace, that huge outsized block that SpaceX has in the space race here. And if I put a 2-day view, you're going to see some of these other issues. They were all down. So we didn't actually have a very good day for these stocks on Friday. They're just bouncing a little bit back today. Here's today. I do want to note that Vanda says that there was a lot of retail buying of those stocks. Even though they weren't supported institutionally, retail traders really love the space trade, and we'll see if they can support these going forward.
The ripple effect of SpaceX. I do want to shift gears, though, with our question of the day and turn to the Federal Reserve, because Chairman Kevin Warsh is set to oversee his first meeting and rate decision this week. Ahead of Wednesday's decision, investors are convinced that the Fed will hold rates steady. But a note from Ed Yardeni this morning suggesting that the story doesn't end just there, with the more dovish Warsh facing an FOMC that leans hawkish. Let's take it to the panel, because Art, I want to kick off with you, because you phrased this as a pretty uncomfortable debut for Kevin Warsh. Walk us through that.
Yeah, well, if you interviewed for the job of chairman as being relatively dovish, which the administration obviously was interested in, and then you're faced with the last three inflation prints that we saw on the CPI, the PPI, and the PCE, and you know at the last meeting there were three presidents have dissented because they wanted the statement to be more balanced and not lean in a dovish direction. You know you're walking into something that's almost impossible not to sound a bit more cautious, right? So they will likely change the statement so it'll be balanced. There won't be an easing bias in the statement. And then the conversation around that is going to be how quickly does inflation come down, if in fact energy prices come down, and what will the Fed likely do this year? There's a good chance the Fed doesn't do anything in either direction for the rest of this year. While we're pricing in, last week we were pricing in a chance for a rate increase by the end of the year. That likely dissipates a bit, but it's going to be difficult for someone who has been known as being dovish, at least to get the job, is going to have a pretty tough battle. There's other things he can do around the edges, too. He's not crazy about press conferences, and he may move that back to every other or when the summary of economic projections comes out. He doesn't like that either, and he may get rid of the dot plot. But those are the things we'll hear about, meetings and meetings from now. I think the first meeting out of the box is going to be an explanation of why the Fed feels like they're at the right place right now at 3.5 to 3 3/4 on the Fed funds.
Inez, at the same time, Ed Yardeni saying that we could see a rate hike as soon as July. Walk us through that note this morning.
Well, what they're saying is they have this contrarian view, basically saying that the Fed could move towards a tightening bias. And part of that, of course, is because inflation is not where they want it to be targeting. It's moving in the wrong direction, so to speak. You also have financial conditions that they are saying are still too loose. I mean, you've got strategists on the street that are saying that while the Fed maintains the rate steady, that is sort of a loosening still of financial conditions. Anytime that they're not hiking rates when you're seeing energy prices that are higher. And this is part of the reason why you've seen sort of the market melt up that you have this year. And also AI investments that have also been, that could be inflationary as well, that could be seen as inflationary. So this economy is going gangbusters. And so what they're basically saying is they've got this sort of contrarian view that, look, they may actually move towards a tightening bias here.
Jared, 30 seconds left. There's this fear that bond vigilantes will come back. What are Treasury yields doing ahead of this meeting?
Treasury yields have actually been down, and that's a good thing. We're looking at the 30-year around, let's say, call it 4.9%. Now, when yields were about 10 basis points, 15 basis points higher a few weeks ago, that was a big concern for the market. In the bond market, it's usually not the level so much, but 5% on the 30-year is a big one. But it's usually the speed of the move. So if something happened in the world and we saw this big jump in yields, well, that would be a problem for stocks. But like I said, they're moving the opposite direction. They're moving moving down now. I think crude oil coming back down to 80 is a huge deal. That's going to alleviate some inflation concerns. I don't think the Fed necessarily hikes rates this year. I think there's maybe an agreement. Okay, we're not going to cut, but we're not going to let things stand the way. We're not going to raise into an economy where we have potentially this war premium on crude oil coming down.
Ooh, Jared Blicker with the hot take. I love it. Thanks so much. A huge thank you to Art and Naz and Jared for joining us this morning. Appreciate your time. Coming up, Julie Hyman has you covered. That's next in Market Catalyst.
This is Market Catalyst. I'm Julie Hyman, about 30 minutes into the U.S. trading day. And as we take a look at the major averages, we have a big bounce in markets here today on the outlook that we're getting to the end of the Iran conflict with the U.S. The two parties talking about a memorandum of understanding that they have signed digitally, that they're planning on signing in person later this week. President Trump has said at that signing that the Strait of Hormuz will once again be open, even though it might take a while for ships to actually start moving through it, for oil to start flowing from the Middle East. The markets are behaving as though it's done now. But of course, they haven't been hit that much by the conflict anyway in recent days. That said, right now the Dow is up about 600 points, a little more than 1%. The S&P 500 up about 1.5%. And the Nasdaq Composite in particular is rallying up 2.4%. Now, looking across asset classes here, the 10-year yield is coming down below 4.5% now on this perception that those higher oil prices were a big part, perhaps, of the inflation and interest rate rate outlook story. We're going to talk more about that in a little bit, but the 30-year also below that 5% threshold that we have been watching closely. Elsewhere, want to point out, of course, what's going on with crude oil futures down around $80 a barrel as we've seen stocks go up on this. Oil prices, as you might imagine, have been coming down. This is WTI off by about 5.5%. And one other asset I wanted to point out what's going on there is Bitcoin. It is bouncing. It has been bouncing here. 60,000 is kind of the lower threshold of where it got to. And so as we see this rally into sort of risk on rally, this is one of the things that's benefiting. Curiously, what catches my eye here is that gold is also rallying, which is not necessarily what you would expect. Also looking at the sector action within the S&P 500, energy down the most. Now, energy, interestingly, is still the best performing group of the year thus far, but could that change if we see more deterioration there? We will be monitoring that. Right now, it's down by about 4%. And actually, I'm going to check myself. If we flip on over to the year to date, actually, it just lost that top spot. Tech is now in the top spot year to date. The XLK up 32%, to energies around 24%. But getting back to today's action, tech is rallying the most, consumer discretionary, industrials, I believe, hitting their first record since March. So really this sort of cyclically led rally that we are watching in today's session. If we look at the Nasdaq and big cap tech, you see a lot of green on the screen here. And it seems like, you could argue it's a sentiment-led rally, right, because of this Iran deal, because a lot of this stuff has nothing to do directly with that conflict or with oil prices for that matter necessarily. I mean, you could argue, okay, there's consumer discretionary, maybe spending with Amazon that's boosting it, or it's just sort of an overall sentiment boost. And then I saw before we were talking about what is going on day 2 of SpaceX. Since this is market cap weighted, it dominates the space heat map that we have. So that stock is up another 7% today after that record-breaking IPO on Friday. But let's get back to the big picture here and talk about this rally that we're seeing in today's session and whether it could be sustained. Joining us now, Jonathan Golub, Seaport Research Partners Chief Equity Strategist. John, it's great to see you in the studio here and to have you with me. So I was just talking about what we're seeing move today on these Iran headlines. And on the face of it, tech doesn't have much to do with oil prices. So it does seem like it's just like the market wants to get this over with. We've known it's wanted to get it over with. It's interesting that it is rallying this much because I think you could argue the market was already pricing in, to some degree, an end to this conflict. But now that it's maybe confirmed, it's rallying even more.
Sure. I mean, it's a risk-on day. If you think about the chance of a global recession, which could have happened if oil would have, gone higher and stayed there for a protracted period, that risk is off. And so the companies that are the most levered to global economic success, which is tech, they're the longest duration assets, they're gonna rally the most. It's not because some company is going to sell more chips or we're going to go and replace our iPhone. Yeah. It really is about the fact that you have a healthier economic backdrop, or at least that's a perception.
And we've been talking a lot, even when there were concerns about a potential recession because of oil prices, the drumbeat and the refrain from folks in your seat have been earnings are strong. And that's the thing that is supporting the markets. What do you think happens from here sort of in tech versus everything else, whether we're going to continue to see sort of broadening or rotation in this rally, and how much of that is backed up by the earnings growth in those other areas?
So there's a really interesting kind of like sub-theme here, which, semis, I believe this year, actually semis I think has the second highest earnings growth this year after energy, because with a higher oil price, what was being projected by analysts was over 100% growth in the second, third, and fourth quarters. And those estimates are going to get revised down because of lower oil. So all year long, analysts, not only in tech, but across the whole market, kept revising their estimates higher and higher and higher. And I think that we're actually going to see over the next few days that the estimates are actually going to fall because the energy numbers are going to get adjusted. Now, there's a process by which that gets adjusted lower. It may take until the reports we get in the next earnings season, which comes in July, where some companies may pre-announce the fact that they're updating their estimates. Companies give that guidance. But all else being equal, this should actually mean multiples higher, earnings in aggregate a tiny bit lower, which is not what you'd think, right?
No, it's not necessarily what you would think. But does it matter? Like, in other words, do you think that that is going to necessarily hold back stocks overall from?
No,
Right.
no. It's not going to matter. I mean, one of the reasons that you were talking about before, that tech and energy were kind of neck and neck is because oil prices are up. But from a market point of view, the benefit from oil to the energy sector and materials was greater than the downdraft on the consumer. So you have to go fill your car, it's more expensive, and theoretically, maybe you go out to the movies less, or whatever you
However you're doing in your
eat more
budgeting, yeah.
pasta than chicken. I don't know.
Yeah.
But the market was saying, actually the data was saying, that the benefit to the energy and material sector was greater than the downdraft for the consumer, it's not the way the dialogue has been playing out, but that's the reality in the numbers.
And so now do you think, does that reverse? In other words, does the benefit to the consumer outweigh?
Yeah, I mean, on the margin, sure. I mean,
Yeah.
on the margin, the consumer is a little bit better off. Industrial companies are a little bit better off. The odds of recession are lower. All else being equal, we're talking about the 10-year. The 10-year is not what matters here. Credit spreads should tighten a little bit. The likelihood of a typical company, wherever they are in America, defaulting on a loan on the increment goes down with this news, and that credit spread tightening means that people can get a loan more easily and things of that nature. The inflation impact, which is what everybody's going to be talking about, and the new Fed chair and the like, I think that's going to be a sideshow to the bigger story, which is the economy is super strong.
I want to ask you something else that's sort of more of on the technical side of the market, and that has to do with supply and demand of shares, of stocks specifically, shares in the market. Because there's been a lot of talk recently, both with the enormous SpaceX IPO coming to market, with companies like Alphabet issuing shares, that the market, which has been dominated by buybacks over the past few years, might actually flip to net issuance, more shares being issued than bought back. And seems to be this emerging debate over, whether that is going to be a little bit of a negative pressure on the market or not.
Well, first of all, buybacks have been basically wiped out already as companies have been issuing shares and they're not returning capital. But let's understand what a buyback is. A company has some cash on their balance sheet, and they can do a bunch of things with it.
Right.
They can sit on it and have it do nothing. They can give you a dividend, or they can buy back their shares. They can also retire debt. This idea...
They can also spend it on CapEx.
They can spend it on CapEx, which they're doing a ton. But this idea that they're buying back their stock and therefore boosting the value of the stock is just really bad math. Let me give you an example.
Yeah.
If companies could buy back their shares and boost the stock, then they should borrow infinitely, buy back their shares, and their stocks will go to infinity. I mean, that's just not the way it works. They have cash flows from their operations, and the market right now is saying your return on that CapEx is more valuable to shareholders than giving the money back to shareholders as a dividend or buyback. Mind you, the dividend yield on the S&P is like 1.2 or something like that. The market is basically saying is use the money because you can, you're going to get a better return, and whatever form of the return, whether it's in buybacks or in dividends, is not as valuable right now to the market.
This reminds me of something that you wrote in a recent note, and I wanted to get you to elaborate on it a little bit. You said cash flows for hyperscalers appear problematic, not the case for tech broadly.
Yep.
But so talk me through what you mean by problematic.
Well, so first let me kind of just draw out the scenario. Let's just say that you're a semiconductor company. You can be AMD or NVIDIA, or it doesn't really make a difference. And I run a data center. So you sell me a chip and you book the profit, and it shows up in your profits, and we get profit growth from that. I don't actually book the expense when I buy that chip because I'm putting in a data center, and I don't start booking the expense until it's complete, and then I amortize it or depreciate it over 3 to 5 years. So we have this weird dynamic where the revenues are being booked and the expense is being delayed, and therefore it looks like earnings are much stronger than they are overall. So the way that you look at this is to say, okay, the traditional way of thinking about earnings is not the right way. You have to look at the cash flows. So the cash flows of hardware, great. Cash flows of semis, great. Cash flows of software, fine. Not great, but fine. But the hyperscalers are investing so much money in this capacity that their cash flows are really really weak. So the cash flow margin has fallen. So if you think about cash flow per dollar of sale, has been cut by more than 50% for the hyperscalers in the last 2 years, something like that.
Okay, so if that's the case, what are the implications of that? Does that mean that at some point they're going to taper off this spending? Is that point closer in time than maybe we think? Is it going to affect the whole machine? Is it going to affect their stock prices? How do you think about it?
When you think about valuing a stock, we normally talk about a PE ratio. You take the price you pay per dollar of earnings. But if a company, what we really care about is the price for dollar of cash flow that the company is going to return back to me. Now, I'm willing to defer when I get that cash flow back to me, a year or 2 or 5, if I think that there's going to be more later on.
But eventually you want it.
But eventually I want my money.
Yeah.
And right now, the earnings of these hyperscalers, the earnings growth, by the way, this earnings season was about 0 for them. I mean, so we had 108% for the semis, 0 for the hyperscalers, but that's on earnings. The cash flows were way worse than that. So on a cash flow basis, they had negative growth rates. And not every one of them, and they're not exactly equal, but that means, all else being equal, that these companies are worth less than they would be if they were more cash flow positive. So they're making they're making a bet here that they're going to get paid. The market right now is convinced but still cautious on this. What's also interesting about this environment is that there's a lot of you're talking about equity issuance. They're also borrowing.
Yeah, well, NVIDIA just announced a big bond sale today.
Yeah, and it's interesting because they're in relatively good cash flow situation compared to others, but the market perhaps maybe it's just that the capital is available and you grab it while you can. Yeah. But bond investors are becoming more concerned. If you invested in a data center and has a 15-year life, but the chip you're putting in the data center only has a 3 or 5 year life, you're kind of wondering, what more do I need to get paid for the bond? If you're investing in the equity, you have, theoretically infinite upside. If you're investing in the bond, you're only getting an extra 100 or 200 basis points of extra return, and yet you're bearing a lot of risk.
Yeah. Okay. So there's a lot of places to look under the hood in the market right now.
Yeah. I don't want to make it seem as if I'm not optimistic. The earnings are fantastic. Yeah. The economy is humming. We've not seen in your professional career, my professional career, this amount of CapEx to build something new, and the examples from the early O's where we're putting cable under the ground. Yeah. A lot of people are talking about like the railroads. I mean, way before our time, but like there's something super special going on here. But it's nuanced, and we need to focus on it.
Yeah. All right, John. Good to talk to you. Thanks so much for coming in. Really appreciate it. Hope to see you again soon. We are also following a wave of M&A deals to kick off the week. First up, Fox is going to buy Roku. It's $22 billion. That's the price on that. Fox is acquiring the streaming company for $160 per share. It's a cash and stock transaction. And the deal will merge Fox's sports and news networks, its streamer Tubi, with Roku. You can see both of the stocks are trading lower, which is interesting. Fox CEO Lachlan Murdoch calling it, quote, a defining moment for Fox. It's expected to close in the first half of next year. It's already been approved by the boards of directors of both companies. It's also interesting because Roku has been talked about as a potential takeover target for years now, and finally that coming to fruition. But it looks like investors not necessarily so thrilled about this. It's interesting to see those Roku shares down considerably below that takeover price, and Fox shares are off by 16%. Perhaps a little confusion over the rationale behind this deal. Next up, Salesforce is buying AI agent platform Fin for about $3.6 billion. That deal, they say, will help the companies expand options for deploying AI agents in customer service. That one's expected to close in the fourth quarter of Salesforce's fiscal 2027. Fin shares, it's private, so we don't see that, but Salesforce shares are up about 1.2%. And finally, Nuvei is acquiring Payoneer for $2.75 billion. The Canada-based payment technology firm, Nuvei that is going to pay all cash for the U.S. financial services company. The transaction expected to close in mid-2027. Payoneer shares are up by a little more than 4%. 0.5%. And then just summarizing all this by the numbers, Fox buying Roku for $22 billion, Salesforce buying Fin for $3.6 billion, Nuvei acquiring Payoneer for $2.75 billion. So feels like an M&A Monday. I feel like we haven't had one of those in a little bit. Coming up, the first Fed meeting with Kevin Warsh at the helm. We're going to dive deeper into what to expect and what rates markets might do as a result. That's next. Kevin Warsh holding his first meeting as Fed chairman this week, with economists expecting rates to be held steady. Joining me now, Ed Al-Husseini, Columbia Threadneedle Global Rate Strategist. Okay, rates aren't doing anything. That's not but there are a lot of really fascinating questions that we're going to maybe get some answers to at this meeting and this press conference. What do you most like? What is the Kevin Warsh Fed going to be like? Like, what questions are you asking specifically to try and figure that out?
Yeah, I think we're all in suspended animation waiting for him to give us a guide on that. I think for me, the most interesting question is, what is his theory of inflation at this point? I think he's been quite vocal about what to do with the balance sheet, changing the Fed's communication strategy, other issues that are more existential for the Fed. But the immediate task is, how do we situate monetary policy? And to do that, you really need to have a story around what's driving inflation at the moment. And I think that's what we're going to start to unpack this week.
Well, we know as of today, maybe it's less energy prices than it would have been, which is perhaps giving Warsh a bit of a gift going into this meeting, right? So do you think that it makes it less likely that there will be a hike this year? Do you think he's going to be able to sort of whip the board in that direction?
It's really tough. In some ways, this is a double-edged sword. We're taking some of the inflation related to energy out of the equation for now. And we're left with a story where inflation was already above target before the war started. It was trending in the wrong direction. And more importantly, the labor market is in a much better spot than it was even just 6 months ago. So it leaves the committee and Chair Warsh with, again, the task of how do we unpack this inflation story? And if we are comfortable staying on hold for the foreseeable future, will inflation come down on its own? If the answer is no, then there's pressure to tighten policy. If the answer is yes, we can afford to wait.
And it's really interesting, the point about the labor market, because on the plus side, the labor market is still growing. On the downside, wages are not growing as fast as inflation, right? So I also wonder how they're going to incorporate that sort of conundrum.
Yeah, and in a way, again, from the Fed's perspective, if you're trying to bring down inflation, seeing wages slow down in the background is a big positive, because it tells you that the labor market is not an accelerant in this equation. If you think back to 21, 22, 23, very tight labor markets, high wage growth, and fiscal stimulus in the background. These are all things monetary policy had to fight against, and they had to work really hard in terms of that hiking cycle. Today, we don't have that. Fiscal policy is a lot more neutral. The stimulus effect of last year's policy changes really kind of start to roll off in the second half of this year. And the labor market, again, from a wage perspective, is just not adding that much to the system. It gives you license to be a little bit more relaxed about inflation at the moment.
Okay, so what are the implications then when we start to talk about what's happening in the rates market, both on the Treasury side and elsewhere across rates? I mean, it's interesting today to see, both the 10 and the 30 fall below those 4.5% and 5% thresholds that we've been watching so closely.
That's right. And I think, look, we're taking a little bit of the energy-related inflation premium out. We didn't have a lot to begin with, especially when we look at U.S. markets relative to, say, Europe, the UK, and emerging markets that built in a lot of premium. So there's a lot more coming out this week. When we look at the U.S., what's been happening that's most notable to me is the curve has been flattening. So we put a lot more hiking premium in the front end. We're anticipating the Fed to pivot from easing, which markets were anticipating just a couple of months ago, to now either being on hold or potentially tightening over the next 12 to 18 months. The question is, can we maintain that? And I think that a lot of that is going to depend on what message we get out of the FOMC.
Do you think Warsh will decline to offer a dot? In other words, his forecast as part of the dot plot or the SEP?
It's possible, from a credibility perspective, if you're really against a particular tool, in this case, forward guidance through the dots, why endorse it by providing a dot? At the same time, this is a collegial organization. You have to build trust if you want to change things and move things forward. He hasn't had enough time to build that, to develop an alternative, say, to the dots. So my bet is we will see a dot. My bet is we will see some language from him in terms of his view of the world, right? It won't be silent. But those changes are coming. Those changes are definitely in train.
He has also spoken in the past about shrinking the Fed's balance sheet, that he thinks it's a mistake that that balance sheet has gotten as big as it has. How soon do you think he could be trying to make that happen? Does he need the buy-in from the committee to do that? And do you see that priced in the market anywhere, that he's going to start to do that?
The short answer is no. It's very difficult to create a path forward to shrinking the Fed's balance sheet. The issue primarily is, what do you do with the liability side? We have excess reserves that are essentially lubrication for the banking system, and we have the Treasury's checking accounts, the TGA. Those are the main components of the liability side of the Fed's balance sheet. So to create a path forward, you have to figure out how to get banks in the financial system to demand less reserves, to live with a lower reserve base. And to do that, I think, is extraordinarily difficult. Or in other words, you run a lot of risks of doing that. So I think it's going to be a slow process. It's very difficult to move forward. From a market perspective, where we're likely to see some disruption is, if you shrink the Fed's balance sheet, when you're running down liabilities, you have to run down assets at the same time. A lot of those are long duration assets. It's long duration treasuries. and mortgages. In the mortgage market in particular, the risk is you widen out spreads as you do it. So I think the market is not quite prepared for that. The side effect could be higher mortgage rates, and I think that's something we do have to think about heading into next year.
Gotcha. Does that mean he's not going to be able to do it? I mean, it sounds like that would be a pretty significant curb on him successfully doing it.
I think it's going to be an extraordinarily difficult debate, because I think it's easy to just look at the overall size of the balance sheet and say, look, it's very large in dollar terms, it's large relative to the size of GDP. But when you take a step back and you try to get into the mechanics of how you actually go about doing it, it is quite difficult.
Yeah. Ed, good to see you. Thank you so much for coming in.
Thank you.
Appreciate it. We got much more markets action coming up. We're going to talk more about the SpaceX IPO, and in particular, talk to a couple of folks who got those shares at the IPO, retail traders who got it, that allocation. We'll be right back. is day 2, of course, of SpaceX's life as a public company. I'm checking those shares out on our Alpha Space platform here. And of course, they have risen. They're rising for the second straight day after that IPO, which went relatively smoothly on Friday, as would have been maybe not expected, right? We didn't see a huge gain on the first day, gain that went off kind of without a hitch here. So we're going to keep talking about these SpaceX shares. Of course, Elon Musk has long courted everyday investors and made sure to give them an opportunity to get in on the world's largest IPO. SpaceX allotted a record 20% of its available IPO shares to those everyday investors. The offering drew in more than $100 billion in retail orders. That drove strong demand the first day of trading. Of course, not all of those orders were satisfied because there was more than was available. We're joined now by 2 of SpaceX's retail investor base who did get some shares, not as much as they wanted. Tamar June is the CEO and president of AssureX. She's been tracking SpaceX for years. She was vying for shares of the IPO. Also with us, Shane Williams, a retail investor from Texas. Actually, he lives now in Albuquerque, who recently received an allocation of shares to the SpaceX IPO. Thank you both for being here. Really appreciate it. And it's really interesting because both of you requested shares. Both of you got less than you wanted, but you still did get an allocation. Tamar, I want to start with you here. So just talk us through the process and how it worked for you, and were you satisfied with the outcome? Did you sort of request knowing that you might not get as many as you had hoped?
Yes, I was told right off the bat that you may not get what you actually want. You know, I requested 1,400, and I ended up with 600 at the night before, and I was happy with that. I knew it was oversubscribed.
Yes, there were a lot of reports definitely about it being subscribed and the action that we were seeing. What about you, Shane? What was your sort of strategy, if you will? And I know you requested shares for yourself and then in a couple of accounts for your kids.
Yeah. I saw that it was way oversubscribed on the retail side for sure. Something like $100 billion, and it was a $75 billion IPO to begin with. So yeah, my strategy, I guess it was a strategy. I just thought it was a cool opportunity to also add it to my daughter's portfolio at the IPO, and I was happy with it. I didn't get nearly as many shares as I wanted, but overall, I thought it was a great opportunity.
Okay, so both of you, talk to me more about that great opportunity as you see it. Shane, I'll start with you. You know, what drew you to this? Are you someone who's invested in Tesla, for example? Are you like an Elon Musk guy and you felt like that this was an opportunity to get in on, if not the ground floor, at least the ground floor of its life as a public company?
Yeah, for sure an Elon Musk guy. I mean, obviously he's the greatest inventor in our lifetime, possibly even humanity. They're obviously aspiring to do things that have never been done before. They're currently already doing things that have never been done before. And so I think if you just extrapolate that success out into the future, it lends itself to what you would expect to be a great opportunity.
And Tamar, what about you? I know that you've also followed Musk for a while.
Yes, actually, I got into SpaceX back in 2020 and again in 2023 through an SPV. I am subject to that lockup period, obviously, but I've been, interested in space technology for quite some time, and looking at how, Starlink came about and the explosive growth and the opportunity in the future for, capturing potentially 20% of the broadband market. Plus, the other area that I'm very interested in is the satellite-to-cell technology, which I'm hoping will come into real fruition where, there won't be any more dead zones and we'll be able to have, excellent coverage wherever you go.
Tamar, it's interesting that you talk about sort of that part of the business as really exciting and attractive. Of course, the company really is 3 different companies, right? Or 3 different main parts of the business.
Right.
You have Starlink, which is the satellite. You have the rocket business, and the bet on Starship. And then you also have the XAI business. And I'm curious how you think about those 3 opportunities. It sounds like you're most excited about the satellite portion.
Yeah, the satellite portion is where the bread and butter is right now. You know, I'm not sure what the other two are going to, go towards. Obviously, you need the rockets to launch the satellites. And then, the Colossus data centers are interesting as well, considering the news that just came out in the last couple of weeks with both Anthropic and Google leasing the data center. Obviously, Elon Musk hoarded so many GPUs that now he's actually being able to use his competitors' money to fund his own projects. So that's interesting as well. The satellite technology is important because the data centers in space are also going to be very big if they can pull it off successfully. And that's what I'm hoping for.
Yeah, if they can pull it off successfully is the caveat, right? And we don't know over the long term if how long it'll take to get them. Shane, when you think about this company as sort of a vehicle for moonshots, both literal and figurative, like what are you most excited about? Like, do you think we're going to Mars? Do you think we should? Do you think that's really a reason to buy the company? Or are there other sort of things that you're more excited about there?
Yeah, I mean, that's their mission, right? That's the first line of their mission statement. So maybe not anytime soon, but for sure in the future. I think along the way, they have these ways of, making money and being profitable. Obviously, they're already great with the satellites, and I think the data center thing is the next big move for them. Obviously, because they're already doing the satellites, and I think once they figure out how to make Starship reusable. It seems like it's on the way. They already have the technology with Falcon, but once Starship is reusable, it makes sending a lot more stuff into space a lot more cost effective.
Right. And finally, guys, I'm curious what you plan to do now. Shane, are you going to try, now that the stock's public, are you planning to pick some more up? Are you waiting for it to maybe fall a little bit before you would get in? How are you thinking about it?
Yeah, for sure, pick more up. We'll see what the price does. It'll most likely be volatile here in the short term. So if it does dip, for sure, and then even if it doesn't dip, because I think long term it's still cheap, to be honest.
Tamar, what do you think?
Well, I'm going to observe. I'm a long-term investor to begin with. So if there is another opportunity to pick them up, I will probably do so, but I'm also holding out for more IPOs later this year.
Tamar, Shane, really appreciate it. You guys are the people that we're talking to and here for every day, so really appreciate you talking back to us. Thanks so much.
Thank you.
Yep.
Coming up, how the price of a backyard barbecue has changed in the past year. That is next on Market Catalysts. Summer grilling season is heating up, but so are prices at the grocery store. According to new data from Wells Fargo, the average backyard barbecue for 10 people will cost about $161 this year. Yahoo Finance's Jared Blickery spoke to Robin Wenzel, head of the Wells Fargo Agri-Food Institute.
Robin, thank you for joining us here. Let's start with, you had me at barbecue. I love barbecues. And one of the stats you throw out is that people are kind of gravitating towards these events like home events as opposed to getaways. And $161 or $200, that is a lot cheaper than a trip to wherever. So talk to us about changing consumers here.
Sure is. So we think with more people opting to stay home or closer to home this summer, you may have an opportunity to really fill up your backyard with a lot of guests. And so we took a look at our summer barbecue report to help people plan and prepare for that and what the cost would be. And as you mentioned, we're seeing about, for a party of 10, it's about $161, $16 per person. And as you said, it's a 2.4% increase, which really is in line with what we're seeing with food prices from the Bureau of Labor Statistics May numbers.
And talk to us about the menu options that consumers have and the changing tastes that we have. Any swap outs there? Is it ribs? Are we talking burgers? Are people maybe changing one ingredient for another because of price?
I think for those hosts that are really focused on budget, hamburgers traditionally are a popular option at backyard barbecues, but with hamburger meat up 14%, they may want to look to other proteins. We are seeing chicken breasts up only 3%. So that's a great option. It's also a healthy, lean protein that's pretty popular right now with many consumers. Pork ribs, though, easy to make for a crowd. They're also up 3%. So that would be another good option.
Well, and let's talk too about the barbecue budget. Are there any trends you're seeing in alcohol, cocktails, and other complements to the standard barbecue fare?
So beer and wine really are only up about 1% year over year. So we're not seeing a big increase there. However, it does constitute a pretty big portion of the budget. So it's always wise to ask people to bring their favorite beverage. That can save hosts some money. The popularity of the single can, the ready-to-drinks is growing. And we're seeing everything from cocktails to functional beverages. Those we're seeing bigger increases in pricing. So we think, again, if you can keep it to the sparkling water, sodas, and ask guests to help chip in with cost. That'll help you save some money.
Now, when we talk barbecue, sometimes that can entail a lot of work, and it's hot out there. Are people gravitating more towards do-it-yourself, or are they getting into the prepared foods and making it a little bit easier?
So prepared foods are always a great option, super convenient. The grocery stores are really leaning in and providing a lot of options, whether it's in the bakery, salads, proteins. So what we're seeing with sides is sides are up a bit. So prepared potato salad up about 4%, cornbread up as well. So there may be an opportunity to save money by cooking from scratch with some of your favorite sides. When it comes to dessert, though, we do see a different story. Really, cookies, ice cream, both are up just 1%, apple pie, 4%. So if you want to save some time, maybe go visit the bakery, but make some other sides homemade from scratch.
Well, I've been told I need to ask you about screw worms here. They've been getting a lot of attention. It's not pleasant to think about, but how is this affecting the foods that people are selecting and also the prices?
Yeah, so it is an evolving situation. As we know, I think the latest count I heard is we're up to about 8 cases in the U.S. We're really not seeing any impact at this time. What we're seeing drive beef prices is just basic, supply and demand. So supplies are at record lows, prices are up. Really nothing filtering in yet from the screw worm.
And who's making out here in terms of the businesses? Is it grocery stores? Is it warehouse clubs, packaged food companies? Where are the investor opportunities there?
I think, with a lot of the big retailers out there that consumers can buy in bulk, that's the greatest opportunity for some of the savings as well as convenience. They tend to be pretty price competitive on a lot of the prepared foods. So we see that as a, growing interest from consumers to try to go buy bulk, save, and then just look for, any other specials that they have out there as we start approaching some of the bigger holidays this summer, like 4th of July.
Coming up, how the energy bottleneck is slowing the AI build out and how one company is looking for ways to fix it. Hyperscalers are estimated to spend more than $700 billion this year on the data center build out. And one of the frequently cited bottlenecks for those centers is power. Our next guest is investing in potential solutions. Mike Schrepfer, Gigascale Capital founding partner. He's also the former chief technology officer at Meta, and he's with us now. Thank you so much for being with us. I have been following this very issue very closely because it has been such a hot topic. So how do you think this is going to go going forward? I mean, do you think that the sort of traditional solutions of, natural gas power, nuclear in some cases we've been seeing kind of have a renaissance? How do you think it's going to go sort of going forward?
Well, I think it's one of the most exciting times that I can remember because we're here talking about electricity and power and infrastructure, normally sort of boring things we don't think about. For the last 15 years, software has been eating the world. Well, AI is making software near free to make. And so really we're talking about competition moving to the infrastructure side, to the atoms. How quickly can I bring compute online? How quickly can I power it? And it's pulling forward a ton of new technologies, whether it's solar, next generation batteries. We've got a company that's looking at building data centers that float in the open ocean and use wave power and seawater for cooling so they don't get in the way of anyone's land and they don't get in the way of grid and raise prices for consumers. So I think there's room for lots of new technologies like that and more.
And I should mention, you guys at Gigascale just closed a $250 million fund in order to invest in some of these things. Talk to me more about wave power, Mike, because, if I look at the various moonshots that are out there, ways to try to harness power from different sources, do you think it happens from wave power first, or do you think we get data centers in space first?
My bet is we'll have both, but I think that wave power will scale. It's about 100 times cheaper to put a ton in the ocean than it is to put a ton in space. So I've got a long sort of cost advantage to burn down there. SpaceX will obviously put data centers in space. They've already got the technology to do it. It's a question of how fast these things will scale and what the economics are. But if you sort of zoom out a little bit, there is solar power that is 99% cheaper than it used to be, batteries that are 99% cheaper than it used to be, next generation reactors, fission reactors that are coming online this summer for the first time, full power up. You've got fusion technologies. You've got all sorts of different ways to produce power for data centers. In many cases, it is cheaper and cleaner than sort of traditional ways of doing this because the rotting cost curves down. Solar gets cheaper every year. Batteries get cheaper every year. And that's the exciting part about this transition.
Mike, what does this assume about data center demand, about AI demand, and whether and when it could stabilize, and sort of what the power needs are going to be, even if it does stabilize at some point?
I mean, that's a $1 trillion question everyone's asking,
Yeah.
right? Is it, how fast are we going to build all these things out? I started this 4 years ago, before the current sort of boom. I knew we were going to grow data center capacity. I didn't know it was going to be this much, to be honest. I wish I did. So I think the demand is going to increase even if we slow data centers. Because even if you delete data centers from the US grid, you still have electric vehicles, you still have onshoring and manufacturing. People are still moving to electrified homes in different ways. And so you have an increase in power demand over the next decade in a way we haven't seen in the last 2 or 3 decades. And that's, going to cause some challenges over the next couple of years. I think people are talking about consumer energy prices. There's a crunch for power equipment. And so the excitement we see is there's a new raft of companies who are here to deliver energy technology, not 10 years from now, but in the next 12 to 24 months, and to do so at a scale and pace that's more familiar with how your iPhone gets delivered or how software gets delivered on the web, rather than traditional infrastructure that takes decades to build.
Well, and we're talking about power generation, but part of the problem is also just the pipes, right? Like the wires, how it gets to us, the grid itself. And so do you think that there is enough investment in that side of the equation? And are we really going to have a huge project across the country that's updating that infrastructure?
The grid is the thing that I am the most nervous about. It is challenging to permit and get, power lines installed. And so, yes, if we can, we should invest everything we can as a country in the grid. I think it's a national asset and key to our economic competitiveness. However, there are alternative technologies out there, in particular batteries. If you look at the ability of someone to build a solar and battery powered off-grid data center, you can probably stand that up quicker than you can get the permits for a new power line. So batteries in particular are a way to sort of shift the power needs and reduce the demand on the grid. So I'm very bullish on battery technology, on solar, on different new techniques, whether it be fission reactors or whether it be, offshore data centers with wave power. There are lots of ways to generate power that basically don't depend on the grid. And we talked about space-based data centers as well. I think you're going to see a huge increase in techniques like that over the next few years.
While I have you, and sort of pivoting away from energy and power for a moment, as I mentioned, you have been the CTO at Meta. You were there when it was Facebook, and you were there when it had its IPO. So we've been talking a lot about the Facebook IPO because of the SpaceX IPO and sort of its size. Yeah. So how do you think about, were you reflecting on it also, watching the SpaceX IPO and kind of thinking about what Facebook was then and what Meta became?
Yeah, I mean, I think about it all the time. For those who remember, the IPO happened under a lot of excitement, and then the stock price, fell quite quickly and stayed there for a while, many, many months, 6, 9, 12 months afterwards. And as a leader of the company, it was a huge challenge at the time. And like many of these companies, the risk hadn't been fully retired. At the time for Meta, the question was, would we be able to compete in a platform shift to mobile? And so I think when you think about companies like SpaceX, there's a lot of promise left. Will Starship work? Will data centers in space work? These are unproven bets that you have to either decide you're going to make or decide you're not going to make. And that's why you're going to see the volatility sort of in the stock price moving forward.
Well, and it's funny because as someone was reminding me earlier today, the talk about Facebook at that time was, can it monetize, right? Which now seems kind of laughable in retrospect, considering how well it has monetized, right? The ad sales in particular. And so I wonder, looking at SpaceX now versus what it become, I mean, could some of these questions maybe be laughable at some point, or maybe its profit engine is going to be different than how it looks right now?
Yeah, I would say that every new technology, every business I've seen, it always looks obvious in hindsight. Everyone knew after the fact that they rewrite their own history on what it was. And yes, that was a concern on Meta at the time, is could they monetize mobile? The way I had belief, why I stuck it out, and what I told all the employees there was sort of looking at the fundamentals. We had a product that people love to use. We had a core technology, which was in that case advertisement. And you're just saying like, hey, can I show content to people that they like? And that's what a good ad is. It's something that they're interested in. And that basics, we had the basics of it. And even though it hadn't been proven, you could see it had the ingredients. So for SpaceX, you have to ask yourself the question, how important is space as a economic environment, and who in the world can catch them right now? Who's been landing rockets, on a near weekly basis? Who has anything at any scale like Starship? And the answer is kind of no one. And if you've ever flown on a plane with Starlink, you almost will never want to fly on a plane without it again. So two things can be true at the same time. They have an unbelievable lead on everyone else, and they're at a price right now which has no bearing on earnings or revenue. So you have to square these two dissonant thoughts in your head, figure out where you come in that spectrum.
And Mike, finally, while I have you, we were very excitedly watching the trailer for the Social Network sequel that is coming out later this year, The Social Reckoning it's called. Are you planning to go see it?
I don't know. We saw the other one on opening day, and it was an interesting piece of fiction.
Okay, well maybe this will be too. We'll see how it looks. We'll see how it's reviewed. Sorry to put you on the spot on that one. I just
That's great. It's fine. It's good.
Thanks so much.
It was an enjoyable fiction story. There's not a lot of bearing in truth in that one. So we'll see how the next one does.
We will indeed. Thank you so much for your time. Really appreciate it. Take care, Mike.
Okay.
Thanks. That's it for Market Catalyst. I'm Julie Hyman. Have a great day, everybody.